So, imagine waking up on a Sunday morning.
Hmm.
You grab your coffee, you're, scrolling through your phone, expecting the usual weekend stuff.
Sports scores, maybe a cat video.
Exactly. And instead, you just see red everywhere. And I don't mean a little dip. You realize that something like $6.5 trillion has effectively vanished.
It really does sound like the premise of a financial thriller, doesn't it? But that was the reality that weekend, January 30th to February 1st, 2026. They're already calling it Black Sunday.
6.5 trillion. I mean, that's bigger than the GDP of most countries.
And the scary part was the speed. This wasn't a slow motion crash over months. This was, what, 48 hours?
Roughly 48
This
hours.
is the definition of a flash crash. And usually, these things are kind of isolated. Tech stocks get hit, so money flows into gold.
Right.
Or crypto crashes and the dollar strengthens. This was different. This is a synchronized cliff dive. Gold, silver, copper, stocks, crypto, everything fell at once.
Which brings us to our mission for this deep dive. We've got a stack of reports, trading data, and some, let's say, colorful forum threads to get through.
Yes, we do.
And we need to figure out, was this a natural correction? Did things just get too expensive? Was it a liquidity crisis where the plumbing of the whole financial system clogged up?
Or, and this is what some of our more conspiratorial sources are suggesting, was this complete manipulation.
It really is a classic whodunit, and the
Yeah.
cast of characters is just wild.
Oh, it is. You have a Reddit trader who might be the luckiest person alive, a new Fed nominee who absolutely terrified the markets, a bank failure in Chicago that everyone kind of tried to ignore.
And then you have JP Morgan, one of the biggest banks, sitting right in the middle of it all.
So let's start with the body count, the metals market specifically. The sources are highlighting a $3 trillion wipeout in gold and silver alone.
But silver really took the brunt of it.
It was a slaughter. There's really no other word for it. Silver had been on this absolute tear leading up to this. It hit an all-time high of around, what, $121 an ounce?
Yeah, on Thursday, people were calling for 200.
And then Black Sunday hits, and it just plummets to $85
That's a 30 to 36% drop
in a single day.
for a safe haven asset.
Exactly. If a penny stock drops 30%, you just shrug. When a precious metal, something used as money for thousands of years, does that, something is mechanically broken in the market.
But before we get into the mechanics of how it broke, we have to talk about the one guy who apparently knew it was coming.
Or at least bet the farm that it would.
Our sources point to a user on the Our Wall Street Bets subreddit.
Yes, the Silver Surfer. This is already becoming a legendary story.
It's incredible. So this trader places a leveraged $350,000 short position on silver, basically betting the price will crash.
And he does this just days before the collapse. You have to understand, betting against silver at that moment was like standing in front of a freight train. The price had rallied nearly 300% in a year.
The trend was vertical.
So the comments on his post must have been brutal.
Oh, merciless. They were joking he'd be living behind a dumpster, asking if he was allergic to profits.
And then 48 hours later, he's a genius.
He caught the exact top, the absolute peak.
One source very colorfully noted that he, quote, earned that coke and pussy, unquote. He didn't just buy a yacht, he probably bought an armada.
It's the dream, right? But seriously, was he a time traveler, or did he see something structural that everyone else was missing? Because a crash this fast isn't just about sentiment changing.
No, it's about forced selling.
Forced liquidation.
That's the key. When you trade futures, you're not buying the metal outright. You're putting down a deposit, which is called margin.
Okay, let's break this down for anyone who doesn't live and breathe futures trading. Is it sort of like putting a down payment on a house, but the bank can change the rules on you overnight?
That's a great analogy.
Yeah.
Imagine you buy $1 million house with $100,000 down.
Okay.
But then the bank calls you and says, hey, the market's a bit volatile. We need another $100,000 in cash today.
Today, and if I don't have it.
They sell the house.
Yeah.
Immediately. They don't care about the price. They just want their money back. That's a margin call. And that is exactly what happened here, but on a massive systemic scale.
The CME group, the exchange itself, they changed the rules right at the peak.
Aggressively.
Yeah.
They hiked the margin requirements. They switched from fixed dollar margins to percentage margins and just kept hiking them from 9% to 11% and eventually up to around 16.5% for silver.
So using our house analogy, the bank suddenly demanded way more cash from everyone.
And nobody had that much liquid cash just sitting around.
Yeah.
So the computers just triggered automatic sell orders to cover the debts,
And that's the trap. When everyone sells at once, the price drops,
which then lowers the value of everyone else's collateral
which triggers more margin calls.
and more selling. It's a self-reinforcing spiral. That's how you get a 36% drop in a day. It wasn't really humans panic selling. It was algorithms forcibly liquidating positions because the rules of the game changed mid-game.
So the exchange tightened the noose, but you still need a catalyst, right? Something to kick the chair out from under the market.
Right. And the reports mention a political trigger coming out of Washington.
President Trump confirmed the nomination of Kevin Warsh as the next Fed chair.
Yes.
Okay, so for the uninitiated, why does the name Kevin Warsh make markets vomit?
It's all about the hawk versus dove thing. A dove likes low interest rates. Printing money markets love doves.
Right.
Warsh is a hawk. He believes in a strong dollar, fighting inflation, even if it hurts asset prices.
So the market sees Warsh and just immediately thinks the party is over.
No more free money.
Exactly. And the reaction was instant. The dollar index rallied to almost 97.
And we have to remember, commodities like silver and gold, they're priced in dollars. So if the dollar gets stronger,
It takes fewer of those stronger dollars to buy an ounce of silver. So the price of silver has to go down.
that's the fundamental math. But there was a second trigger, a much weirder one, involving what people called fake news.
Oh, this part is terrifying. A report started circulating, supposedly from Reuters, saying the U.S. government was ending support for strategic metals reserves.
And a human trader might read that and think, wait, that sounds weird. Let me check that.
But markets aren't run by humans anymore. Not really. They're run by high-frequency trading algorithms.
The algos.
These programs scan news feeds in milliseconds. They just saw the keywords government, ending support, metals.
They don't get nuance.
No, they just execute sell. So before that report could even be clarified or retracted, billions were dumped in fractions of a second. It created what one source called a slaughterhouse environment. And it wasn't just silver.
No, copper fell 10%. Platinum dropped 23%. It was a sell everything moment because the machines got spooked.
Okay, so we have the hawkish Fed nominees scaring the big picture investors. We have fake news scaring the robots. And we have the exchange hiking margins to force liquidations. I mean, it really was a perfect storm.
It was, but,
I hear a but in your voice.
well, whenever a crash is this perfect and this convenient for certain players, people start looking for a villain.
And the trading communities are pointing a very large finger at JP Morgan.
The JPM theory.
I was reading through the threads on this, and the accusations are pretty wild. But is there any credibility here? Or is this just people looking for a scapegoat?
Well, let's just look at the data. To get the accusation, you first have to understand the paper problem. The COMEX, the main futures exchange, reported about 105 million ounces of registered silver.
Okay, and that's the silver that is actually physically available for delivery.
Exactly, 105 million ounces, which sounds like a lot,
Until you look at the open interest, the number of paper contracts people had bought.
which was 490 million ounces,
Wait, so there were claims on nearly 500 million ounces of silver.
but only 100 million in the vault.
So almost 5 paper claims for every 1 real bar of silver.
Correct.
That sounds like a disaster waiting to happen if everyone just asked for their silver at once.
The exchange breaks, it defaults, it's a run on the bank, but for metal. And here's where the theory comes in. If the price keeps screaming higher, more people might decide to ask for physical delivery. The exchange was in the danger zone.
So the crash saved the exchange.
By crashing the price 30+%, they fleshed out all those contract holders. If you get liquidated, you can't ask for delivery. You're just out. The crash conveniently solved the run on the vault problem.
And what about the specific accusation against JPM?
The smoking gun that's circulating is the daily delivery notice data. It showed that a JP Morgan customer account issued 100% of the daily delivery notices. 633 contracts.
100%. All of them.
Every single one. And sources are alleging they closed their short positions at the exact bottom of the crash.
Okay, let's play devil's advocate for a second. JPM is a massive market maker. They have the biggest balance sheet. If the market is crashing, isn't it kind of their job to be in there hedging and making moves?
That is the charitable interpretation, for sure. And it's probably what their lawyers would say. We provided liquidity when no one else would. But it's the timing that really sticks in people's throats.
How so?
The theory is they flooded the market with sell orders to push the price down, which triggered that margin cascade we talked about. And then they bought back their own positions at the bottom for a massive profit, a calculated liquidation flush.
It's the difference between spotting a fire and pouring gasoline on it so you can buy the burnt-down lot for cheap.
Precisely. It wipes out retail investors, our silver surfer being the very rare exception, and lets the big banks cover their shorts cheaply.
And we can't ignore the China connection in all this, right?
No, you can't. The Shanghai Gold Exchange was a big part of this too. There'd been this huge arbitrage where silver was more expensive in China. But right as this was all unfolding, China reportedly rug-pulled the speculators.
They curbed trading and hiked margins, too.
So the exit door slammed shut in Shanghai at the exact same moment the floor fell out in New York.
Nowhere to hide.
Nowhere.
You know, while all this drama was happening with trillions of dollars in metal, there was a smaller headline on Friday that I feel like we need to spend some time on.
The bank failed.
Yes.
Yeah?
A Metropolitan Capital Bank and Trust in Chicago.
Now, I saw the numbers. $260 million in assets, which in the banking world is tiny. It's a rounding error for JP Morgan, so why are we even talking about it?
Because in finance, you never look at the size of the first domino, you look at why it fell. And this was the first U.S. bank failure of 2026. And the timing, Friday afternoon.
The classic Friday night dump.
Yeah.
Regulators seize it after the market closes, so they have the weekend to clean it up.
Right. But here's why it matters. The sources are pointing to unrealized losses as the culprit.
We hear this term all the time. Can we just unpack what that actually means for a bank?
Sure. So banks take your deposits and they buy safe assets like government bonds. Let's say a bank buys a bond that pays 2% interest. That's safe, right?
That sounds safe.
But then inflation goes crazy and the Fed raises rates to 5%. Suddenly, that old bond paying 2% it's worthless trash. The market value collapses.
So the bank doesn't lose money unless it sells the bond. That's why it's unrealized.
Bingo. As long as they can hold it to maturity, they're fine. But if depositors get scared and they want their cash now,
The bank is forced to sell that bond at a huge loss to get the cash.
and poof, the loss becomes realized, the bank fails. And the really scary stat is that the entire U.S. banking system is sitting on something like $340 billion of these unrealized losses.
So Metropolitan Capital failing on Friday.
Mm-hmm.
It's the canary in the coal mine.
It suggests liquidity is tight everywhere. A bank failing on the same weekend the metals market implodes. That tells me this wasn't just about commodities. This was a systemic liquidity event. The plumbing was dry.
And when the plumbing is dry, the weakest links break first, like a small bank in Chicago or a leveraged silver trader.
This brings us to the twist ending of this whole saga. Usually when the plumbing dries up and everyone is panicking, the riskiest assets get sold first.
Right. If I need cash now, I sell my crypto.
That's the historical correlation. Crypto usually bleeds first.
But that's not what happened. I mean, Bitcoin dropped, sure, but compared to silver.
It was the great decoupling. Silver crashed 36%. Bitcoin fell maybe 6 to 8%, dipping to around 76,000.
Which in crypto terms is just a Tuesday.
Exactly. It was remarkably stable. We're seeing institutional notes from Standard Chartered and Bloomberg suggesting that Bitcoin acted as the strong man in the room.
Why, though? Why would digital money hold up better than physical gold or silver in a crisis like this?
It comes back to that paper problem we talked about with the COMEX. The metals market is just so diluted by paper contracts and leverage.
But there are futures in Bitcoin, too. People leverage crypto all the time.
Oh, they do. And there was pain. Over $2 billion was liquidated in crypto. We saw a report about one trader who went from $142 million in profit to zero in 56 days.
Ouch. That is a bad weekend.
But look at the structural difference. When the silver market broke, the exchange had to intervene. They had to change the rules to save the system.
Bitcoin. The price dropped, the leveraged traders got wiped out, and the network, it just kept going. No bailouts, no rule changes.
And here's the really fascinating data point. 335,000 new addresses appeared on-chain during that crash.
So while people were being forced to panic sell paper silver, other people were actively buying the dip on Bitcoin.
It suggests a real shift in mentality. Investors are starting to see Bitcoin as digital liquidity. It's an asset you can sell instantly, 24/7, without waiting for a bank to open.
This brings up a concept I want to touch on, which feels like the theme of this whole deep dive. Counterparty risk.
It's the underlying theme of the whole weekend.
For the listener, counterparty risk is just. It's the risk that the other guy doesn't do what he promised. Right?
Simple as that. With the bank in Chicago, the counterparty was the bank. You trusted them with your money, they failed. With the silver futures, the counterparty was the exchange. You trusted them to deliver the metal. The system buckled.
And with Bitcoin.
Who is the counterparty? If you hold your own keys, there isn't one. You're not relying on a CEO or a bank manager or a Fed chair. You're trusting the code.
It's the is it mine test.
Right. We always ask, is this investment safe? But after a weekend like Black Sunday, the better question is this investment actually mine?
And if it's a paper claim on a metal that doesn't exist, or a deposit in a bank with a hole in its balance sheet, the answer is no, right when you need it to be yes.
That is a sobering thought. So we have a hawkish Fed coming, which means money is going to get tighter. We have banks sitting on hundreds of billions in losses. And we have markets that can flush 30% in a day just to keep the gears turning.
It's a fragile system. We forget that when stocks go up every day. But when the tide goes out like it did this weekend, you see who's swimming naked.
So what's the takeaway?
Oh.
Stuff cash in a mattress. Buy gold bars and bury them in the yard.
I think the takeaway is just awareness. Understand what you actually own. If you're trading leveraged futures, understand the house can change the rules. If you're in a bank, pay attention to its health. And maybe look at why some assets are behaving differently than they used to.
It wasn't just a crash, it was a stress test.
Yep.
And the results were mixed, to say the least.
The plumbing held, but it leaked everywhere.
Well, on that cheerful note, we're going to wrap it up. Whether you're the silver surfer counting your millions or just someone trying to make sense of a $6 trillion vanishing act, keep your eyes open.
And maybe check your margin settings.
Definitely check your margin settings, keep your charts handy, and your leverage low. Until next time.